Welcome to the deep dive. Today we're taking apart the strategy and recent results of a key player in the real estate space, Raymond Realty Ltd, RRL.
That's right.
We're diving into their Q2 and H1 results for FY26, focusing specifically on their operations within the very competitive Mumbai metropolitan region, or MMR.
Yeah, and we've got a pretty dense stack of sources here, results up to September 30, 2025. Our mission really is quite targeted.
Okay.
We need to figure out this central tension. Is RRL intentionally sacrificing short-term performance, let's say, to prime a massive new growth engine? We're looking at their dual strategy here, maximizing that legacy land bank they have in Thane, while at the same time aggressively pivoting to an asset-light joint development agreement model, the JDA model.
Absolutely. And before we even get into the RRL specifics, maybe let's zoom out a bit. Because what's fascinating here is seeing the context they operated in.
Right, the broader market.
Yeah, the sources suggest these broader macroeconomic factors, like the RBI's monetary stance, firm domestic consumption. They seem to be creating some powerful tailwinds. Okay, let's start there with that market momentum.
Yeah, I think that's key. The environment has been, well, overwhelmingly positive. The Indian real estate sector,
Yeah.
it's shown remarkable resilience.
Really?
Oh, yeah. It's been on a sustained upward trend for, over 2 years now? This isn't just a cyclical blip,
Okay, and what's driving that? We see maybe two immediate factors. First, the monetary environment. The Reserve Bank of India's stance, keeping that repo rate steady at 5.5%. That means home loan affordability stays attractive.
Crucial.
Gives buyers confidence, right?
Absolutely. And secondly, the underlying consumption momentum is just rock solid. India's overall growth story, unlike many others globally, is strong.
Right.
We're seeing firm domestic demand for large ticket purchases. Car sales are up, housing sales are robust. People seem to have the means and, importantly, the willingness to commit to these big purchases.
But the crucial nugget here, maybe the structural shift that really benefits players like RRL, is this flight to quality idea.
Yes. Huge point. Buyers are no longer, let's say, willing to risk unproven or smaller developers. They're moving towards branded players.
Why is that such a big deal now?
Well, it's a huge shift, and it seems cemented by tighter regulations, increased consumer awareness, especially post-RRA. Consumers want guarantees on project completion. They want transparency.
Peace of mind.
Exactly. And they're willing to pay a premium for that brand assurance. So this naturally concentrates demand among the trusted names.
And when you look specifically at the MMR market Bombay, the activity is just staggering.
It really is.
The property market keeps running strong, driven by sustained end-user demand, and crucially, this trend toward larger, more premium homes.
Yeah, and to put a number on the sheer energy in that market, the festive season, covering Navratri and Ganesh Chaturthi, it's almost 10,600 property deals.
Wow.
That's a 23% jump year on year.
23%.
Yeah, that's not just incremental growth. That's the market really back with a vengeance.
Okay, that 23% jump is incredible energy. So this brings us right back to RRL. Given this booming environment, how do we square that with RRL's H1 FY26 consolidated results? Because frankly, they look quite flat. It almost looks like they missed the boom.
That's the challenge, isn't it? Total income for H1 was 1,098 crores. That's only 1% year-on-year growth.
Just 1%.
Yeah. Their booking value was 760 crores, and EBITDA came in at 143 crores. Those numbers definitely look like they sort of paused while the market sprinted ahead.
So was this a failure to execute then, or was it like a strategic pit stop?
Well, the sources are pretty clear on this. This was actually a planned transition.
Planned.
Yes. It reflects a necessary pause. See, they had a massive Q4 last year, which basically depleted their ready-to-move inventory. So
Okay.
H1 was spent doing the less glamorous but, essential work.
Sure.
Getting regulatory approvals, finalizing designs, preparing the ground for a huge pipeline of new launches.
Right.
They kind of hit the brakes briefly, deliberately, to make sure the engine was fully serviced for the acceleration plan in H2.
Okay, so a strategic preparation period. That makes sense.
Yeah.
And it's worth noting, while H1 overall was flat, Q2 did show some signs of life, right? Total income for Q2 FY26 was 706 crores.
Yep.
That's a healthy 20% year-on-year growth over the previous year's Q2.
Exactly. And pre-sales for Q2 were 455 crores, mostly driven by continued robust demand for their existing, more mature projects like 10X Era and Address by GS.
Okay.
So the established inventory is still churning out cash flow, which is absolutely vital when you're gearing up for an aggressive new launch cycle like this.
Right. Now let's pivot to that forward-looking strategy because this is where the picture gets, well, complicated but also deeply interesting.
Yeah.
RRL isn't just running one growth engine. They seem to be running two that need very different kinds of fuel.
This really defines the company's future, I think. Engine number one is that legacy asset, the thing that made them famous, the Thane land parcel. Huge. They own approximately 100 acres in Thane, with a total potential revenue estimated around 25,000 crores.
25,000 cores. That's a staggering long-term asset.
Yeah,
And they're monetizing it steadily, yeah? Currently, about 55 acres are under development,
correct.
which translates to 5.8 million square feet of RERA carpet area.
And their progress on this legacy asset is really their financial anchor right now. Of that development segment, they've already sold 8,200 crores worth of property
Wow.
and successfully collected 6,300 crores. The product mix there is mainly targeted at the sort of 2 BHK, 3 BHK community segment,
Yeah.
generally priced upwards of 2 crores, though they also do some high-end stuff up to like 17 crores.
Okay. Now for Engine 2, this transformative shift to the Joint Development Agreement, or JDA-led business model, the asset-light expansion. Why is this so crucial? What does it look like?
It's crucial because it moves RL from being primarily a land-rich owner-developer, which is very capital-intensive, to more of a pure development service provider. They leverage their brand and their execution capability, while the landowner provides the actual asset. They've already signed 6 JDAs in the larger MMR region, mostly in prime Bombay spots, including areas in and around BKC.
And this JDA portfolio, this asset-light portfolio itself, has a potential revenue of about 14,000 crores.
That's the estimate. So if you combine both Engines Thane and the JDAs, the total potential revenue is close to 40,000 crores.
That figure is massive, just huge.
It is massive. But here's the kicker, the strategic goal.
Okay.
They're aiming for these JDA projects to make up 50% of their annual pre-sales within just 2 to 3 years.
50%.
Yeah, this isn't just adding to the portfolio. It's an absolute structural pivot. They want to become a development management powerhouse.
Yeah.
If they hit that 50% goal, the whole financial profile of the company changes dramatically.
So the risk here then shifts, doesn't it? From land cost risk, maybe, to execution risk across lots of different projects, geographically diverse in a really short period. That makes the second half of FY26 absolutely vital. It has to deliver on the promise of that H1 pause.
It really does. H2 is scheduled to be much, much heavier activity-wise. They're launching, I think, 7 to 8 projects, really trying to leverage those festive season tailwinds we talked about.
Okay, so break down that launch timeline for us.
All right. Q3 is focused mainly on the asset-light model, the JDAs. They've got 2 coming, one in Bandra and one in Wadala.
Okay, prime locations.
Very. And then Q4 accelerates even more with 4 more projects. 2 more JDAs, one in Sion and one in Mahim, plus 2 more projects back in their core Thane area.
Right.
And importantly, one of those Thane launches is a much-needed 2 BHK community project. That replenishes the inventory they basically burned through last year.
The scale of this pipeline is huge then. The cumulative gross development value, the GDV, that's expected to hit the market just in H2. It's in the ballpark of about 5,000 cores.
Yeah, around that number, which is an enormous amount of new product launching in just a 6-month window.
So that brings us straight to the financial tightrope walk. How on earth do you fund nearly 5,000 crores worth of launches while keeping that financial discipline?
Especially when?
They're still net debt-free, right? With a cash surplus of 48 crores as of September 2025.
Exactly. It seems contradictory, but it's actually quite a sophisticated balance.
How are they doing it?
It's a combination of 2 things. First, internal accruals, the steady, massive cash flow coming from the mature Thane projects we mentioned, that's the bedrock.
Okay.
And second, they use highly disciplined, low-cost debt. Currently, they're borrowing at under 10%. And they have this firm commitment. Never exceed a 1-to-1 debt-to-equity ratio.
So the debt is purely strategic leverage. It's not desperation. They're making sure any capital raised targets, what, a 20% return on capital employed? Or higher?
Precisely. They're borrowing money only for high-confidence, high-return projects. It's using debt as a tool for acceleration, not as, a replacement for cash flow.
Okay. This leads us directly back then to maybe the most critical question for anyone watching this company, the margin profile. We established the reported H1 EBITDA margin was 13%. That's significantly below their own long-term blended guidance of 20%. Why the big gap?
Yeah, this is a crucial and maybe counterintuitive piece of knowledge for tracking growing real estate companies. It comes down to how project maturity affects reported profitability.
Okay.
That 20% EBITDA margin they talk about, it's promised on a blended basis, meaning across the entire life of the project, not necessarily in its first few reporting quarters.
Ah, this is the hockey stick effect we saw mentioned.
That's exactly right.
Yeah.
Revenue and critically the margins, they get recognized across the project lifecycle like a hockey stick.
Right, low at the start, high at the end.
Exactly. Margins are typically lowest right now at the launch phase. Two reasons. One, initial pricing is often set a bit conservatively to drive those initial sales volumes. Right. And two, you have significant large upfront cost approvals, construction mobilization that hit the P&L, the profit and loss statement, immediately.
But the margins improve later on.
They improve substantially as the project matures, primarily due to price escalation. Over a typical, say, 5-year project life, the company estimates apartment prices tend to escalate by around 10% per year.
Okay.
That appreciation, that price increase, translates directly into higher reported margins later in the project's life.
So because RRL is bunching up all these new launches, that whole 5,000 crores GDV pipeline in H2, the financial reporting is going to reflect a temporary margin squeeze, or maybe bumpiness, as they put it, for the next, 3 or 4 quarters?
That's precisely the management expectation. They're essentially investing heavily now for future profitability. They're prioritizing growth right now. They expect the stability and hitting that targeted 20% blended margin goal to really show up in the reported numbers by FY27.
So patience is needed on the margin front. Seems so. But despite that near-term margin pressure, they are absolutely determined, they say, to deliver a minimum 20% growth in booking value that's pre-sales for the full fiscal year 2026.
Okay, so what does this all mean for you, the listener, trying to make sense of this? We've seen a strategically executed H1 pause, followed by a massive H2 launch effort, funded by a pretty disciplined use of debt and internal cash flow. And the core story is this strategic pivot to the asset-light JDA model.
Yeah, pushing the company from primarily a landowner to more of a development manager.
It's quite a shift.
It is. And the company is attempting really a high-wire act, maintaining its net debt-free financial status while rapidly launching this huge asset-light portfolio, which, as we said, will inevitably put short-term pressure on those reported margins. So here's the final thought, the provocative question maybe. Given that structural commitment to the asset-light JDA model and knowing that reported margins will be temporarily bumpy, what's the single most crucial operational metric we need to see delivered in Q3 and Q4? What confirms this highly aggressive strategic shift is actually working on the ground? Forget margins for a second. Focus on execution and absorption. How quickly are these new launches selling? That's the question you should probably be tracking over the next 2 quarters.